Hey guys, so it's been a little bit of a while since I've done one of these. I was rewatching one of my previous videos and thought, man, I should get back to doing those sorts of things. So going to run through two main things today. The first one is the CoreLogic monthly housing chart pack, and then the second one is the RBA chart pack as well. Just to unpack a little bit of things that are happening out there in the market. I'm personally in the market at the moment looking for our principal place of residence and seeing a few interesting things from my side, which I'll go through as well, but just wanted to go through the reports and sort of see where everything's at and see where we're sitting with things. First page as usual is just a bit of a breakdown of the market. So residential real estate is 9.8%, $9.8 trillion, with an outstanding mortgage debt of about 2.1. So overall LVR of the property market's like 25% or less. Sorry, yeah, probably less, a little bit less. 22, 23%, which is pretty crazy. To think there's probably a lot of generational wealth that's stored within property and hasn't been released within property and kind of just sitting there on the books, where a lot of the new younger generation getting in is where most of the debt sits. Typically they're the higher income earners though as well, so the younger sort of higher income earners are the ones who are pulling out loans to get into these properties, where some of the older generations might just be sitting on this on typical real estate going forward from here. So pretty interesting breakdowns to sort of see how everything is. And then again, this big number here of 47% of household wealth is held in housing, which is pretty crazy. Bit of an overview. So the 3-month values of -2%. So national home values have fallen 2% in the 3 months to July, which accelerated from -0.2% fall in the June quarter. So really starting to see a downturn come into play now. Not necessarily majorly, not sort of market crash as a lot of people or commentators have been saying, but we definitely are sort of seeing some negative numbers come through, which generally, you'd expect these sorts of numbers based off the rush that we went through over the last 18 months. When you have big highs, you have lows as well, and everything's not a straight line and perfectly goes up. We do have to sort of see these values come down as well. The 12-month though, it's still up 8%. So Australian average over the last 30 years has been 6.8% every year, compounding over the last 30 years. So to be at 8%, we're still above average on a 12-month basis period. So that's pretty interesting. Dwelling values in Australia are 8% higher over the past 12 months, down from the cyclical period of 22.4% recorded in the 12 months to January 2022. So we're coming back down to averages now, which is really interesting. We've had this big peak, and it's essentially because the RBA have dropped the cash rate to 0.1% during a COVID pandemic to sustain the economy. All of that funding and extra housing and borrowing capacity increases went straight into property because the banks or lenders or lending policy didn't change at all. And so, you could get more lending, which all went into property and essentially just sat there. And now that the reverse is happening with the cash rate going up, it's coming, the borrowing capacity is getting harder again, which means people have less money to spend on property. And that's where we start to see the downturn. And then we've got this little capital cities thing here. So most capital city markets are now in decline through the month of July. 5 of the 8 capital cities saw a decline in dwelling values, while growth rates slowed in the remaining 3 cities. Yeah, interesting. So 5 out of the 8 capital cities saw a decline in dwelling values, while the rest are still going. And that's just to sort of show you that, there's not sort of one Australian property market, and unfortunately that's how a lot of commentators present it, is this one big property Australian market. But at the end of the day, there's markets within markets. There's said to be at least sort of 1,000 sub-markets across Australia, and they're all performing differently. So 3-month changes, capitals are down -2.6, regionals are down 0.2. So a bit of a lag delay there from the capital side of things. From the regional side of things in terms of following the capitals. We can see some big swings and ebbs and flows here though. Down here we had the 2019 election, which led the bigger downturn here. There's a big up, then a big come down, and then a big up from COVID. Now we're coming back down again. So you can see how dramatic it's gotten, considering back in 2012 how different the percentage values are. they're showing much more volatility in recent years. It's something I'm pretty interested in watching sort of how this moves out moving forward. Relatively speaking, there is a lot more money in the economy at this later stage of our economic cycle, but the volatility there is definitely getting quite large compared to where it was not too long ago. 12-month change, again, you can sort of see that volatility in here, not to that extreme, but Australia as a whole is up 8%, regionals are up 17%, and capitals are up 5.5%. So what we're seeing here is regional cities booming during the COVID pandemic. Everyone was trying to get out of the capital cities, enjoy that sort of work from home lifestyle, get away from lockdowns, all those sorts of things. Capital cities did increase as well, but now we're getting hit harder with this downturn at a much faster rate. You can see here that this downturn has really significantly happened on the capitals, where compared to regionals, we're slowly showing on the decline here. And typically, if you watch it, in the past, the regionals follow the capitals by a delay. Not to say that regionals are going to continue to decrease or decrease at the rate that the capital cities have. And I think this spread will be quite interesting to watch moving forward with the whole, we are essentially in a different economy at the moment with the whole work from home movement. I mean, I've been fortunate enough to be able to work from home for sort of the last 10 years or so. But I think it's, especially if you have a young family or you enjoy a little bit more of a lifestyle, like going for a surf or, do something in your daily routine that doesn't allow you to have to spend half an hour getting ready and half an hour to an hour getting ready, 45 minutes on the train, 45 minutes on the train back, having to be required to be closer to a CBD to allow you to get there. The regionals have really opened up a different demographic and a different type of lifestyle that others may enjoy. So it'll be interesting to watch that spread and how it changes over time. So just based on the capital cities now, so Sydney, Melbourne, Brisbane, Adelaide are all down. Perth, Hobart, Darwin, ACT, sorry, incorrect. Sydney, Melbourne are down. Brisbane and Adelaide are still up overall. We've got Perth and Darwin still positive, so they're the four that are still positive. And then we've got the ACT and Hobart on the decline now as well. Adelaide is still really, really high on the 3.6%. Sydney and Melbourne copying it first, but they typically lead the pack as well and are much more volatile compared to the other markets. If you have a look at Brisbane and Adelaide stay quite clustered together here, where Sydney and Melbourne move much more volatility or have much more volatility, but stay clustered together as well, apart from this little period here and during the COVID pandemic where Sydney really overtook the Melbourne market. And then this is what I'm seeing out there at the moment. There's three types of tiers that they break it down here. So the bottom 25th percentile, the 50th percentile, and the 75th percentile. And what we can see here is the high valued properties are what are having the biggest impact pull down. And that's typically because, again, that volatility. At the higher range of incomes, there's bigger borrowing capacities. But when interest rates move, the borrowing capacities come down significantly, and those higher valued properties have more volatility or get impacted the most at the start compared to the smaller ones on a percentage basis. So interesting to see here that the higher valued assets are declining or leading the pack in terms of the decline. You can see in Brisbane it's even happening while the bottom two are still positive. Hobart, all three are on the way down, and ACT again is shown here, even though the smaller valued assets are still on the positive. So really good to sort of break the tiers down at that level and see how much things are getting impacted. What I am seeing there, especially out in auctions, as long as there's still sort of 2 to 3 bidders on a dwelling, they want it and they've got the borrowing capacity to go for it, they're still paying good market value for properties. That we've actually been to 2 auctions that we were pretty serious about. I'm a firm believer of letting everyone show their hand before we bid, so we didn't actually bid. But something that was, I think there was a bit of underquoting going on, but there was one that was valued 155 to 165, sold for 18, and then another one that was 125 to 135, and it sold for 15. So you know, as long as there's 2 or 3 bidders that are out there after the same property, it can drive the price of continue to drive the price of property up. And so it's probably more the second class assets that still good blocks, good fundamentals, all those sorts of things, but may require a bigger renovation or something like that we're starting to see the values come down at that higher range. Housing cycles, capital cities, and that's just based in Melbourne where I'm looking, not anywhere else across the country. It's kind of what I'm seeing on the ground there, but I guess it's just to justify, if people still want an A grade asset, they're still gonna, and there's more than one of them, they're still gonna bid for it. So the rolling 28-day growth rate in CoreLogic daily housing index is down to negative 1.4%, and we get a really nice breakdown of what's happened here. We can see the first rate cut on the 3rd of May goes back up a little bit, but then the decline starts to happen. 7th of June is the 2nd, 5th of July is the 3rd, and then we keep going down from here. We can sort of see that negative impact come down slowly over that period, pretty stagnant, to the 2nd of February from there as well. So definitely seeing that 28-day growth come down. The rolling 28-day in changes combined capitals homes index was negative 1.4 at the 31st of July. The change in home values had been slow since March 21 amid affordability constraints and the tight lending conditions. However, since the tightening in the RBA cash rate steadying, the pace of the ease in the market values has accelerated. Just got a little breakdown there. So we've got Sydney down in July by 2.2%, the quarter nearly at 5%, but still positive based over the past year. Melbourne down 1.5% on the month, 3.2% on the quarter, but still neutral over the past year. Brizzy down in the last month, neutral over the quarter, but up 22% over the last year. Crazy. Adelaide's 0.04 for the month, up 3.6 for the quarter, and again 24% over the last year, which is crazy. Perth is pretty normal, so up 0.2% for the month, 1.2% for the quarter, and then 5.5% over the last year. And then Hobart is down 1.5% over the month, down 1.3% over the quarter, but up 10% over the last year as well. So they're still very much in the positive compared to some of these declines that we're starting to see come through. Darwin, up 0.5% over the month, 1.9% over the quarter, and positive 5.3% over the last year, so coming down to some normal rates there. Canberra, down 1.1% over the month, down 0.9% over the quarter, and then still up 12% over the year. So starting to see, the monthly rate of decline higher than the quarterly rate of decline, and we're seeing that in a bit of a downturn now. So yeah, it gives you a bit of a breakup of the major capitals. So sales and listings. National sales volumes are starting to ease from the recent highs. CoreLogic estimates that in the 12 months to July, there were 581,000 sales nationally. This was relatively steady compared to the previous year, while up annually, initial sales estimates over the 3 months to July were negative 16% lower than the same quarter of the previous year. So 16% less sales are transacting this year compared to last year, which is crazy. But just goes to show you that, there's probably not a lot of stock on market at the moment, and people are worried about interest rates and everything else that's happening in the economy, and so kind of putting a bit of a back burner on the pedal. We can see this sort of rise up during the COVID pandemic, and then it's coming down to that sort of 5-year average line there as well. So pretty interesting to see. Days on market at the national level, properties are taking longer to sell. In the 3 months to July, the median days on market was 32, up from the recent low of 20 days over the last 3 months to November. So days on market is essentially how long's a property listed for on the market, on any of the big portals, or real estate agencies, or the real estate agent talking about it. And that's a very vague way of putting it, and I think sometimes certain properties can be given the wrong numbers. So you're not always sure that these numbers are 100% accurate, but what we can see as a general consensus is that days on market did come significantly down between July 20 and July 22, and now we are on the way up again, up to about sort of 29, 30 days on market. Typical auction campaign is 4 weeks, so we're thinking sort of 28 days there. Our combined capitals are now at 29 days, so we're above a 4-week campaign, which typically means properties are going to auction, either passing in and getting negotiated after the fact. Less properties are selling prior to auction, or on the regionals. I mean, they are coming up a little bit high, but when you start to get those larger numbers, sometimes properties can be going through 2 auctions or two auction campaign periods as well. So pretty interesting to watch. Vendor discounting is coming down. So similarly, vendor discounting has also increased from the recent low of negative 2.8% recorded in the 3 months to April last year. And the 3 months to July, the median vendor discount at national levels was negative 3.8%. We can see that the combined capitals are now down negative 4%, and combined regionals are negative 3.5%. Super interesting because it is very dramatic from sort of what we were seeing not too long ago. Looks like we're even closer to sort of 3.2% or so. Not too long ago, and so now to come down to negative 4 is pretty interesting. Just means people are willing to sell their properties for less, discount their properties to be able to get a deal done. Listings in the 4 weeks to July, there was 35,000 newly advertised dwellings listed for the sale nationally. In recent weeks, the flow of new listings has seen a seasonal slowdown, but is still higher than 5-year average of this time last year. Oh, that's very interesting. So the listings on board are actually higher than the 5-year average, and they're actually significantly higher than most of the years previously as well. So seasonally, we are in winter. Most people, just want to stay indoors on the weekend and stay out of the rain. Again, flowers aren't blooming, grass doesn't look great, all those sorts of things, and so vendors don't want to put their properties on the market just because of the way they look. So we have a seasonal slowdown at this period, and then we have that September selling season or the spring selling season where we see a big uplift between sort of spring and end of November before we go into the December closure and Christmas and slowdown period. Listings again, at the national level, total listings are gradually rising but remain below the average for this time of the year. Total stock levels remain negative 24.8% below the 5-year average. What's the difference between these two? New listings and total listings. Cool. So no new listings, we're seeing a fair bit come on, but total listings overall is down 24% compared to previous years, which is pretty crazy. Yeah, so of all the previous years, back to 2018, we're actually at the lowest total listings than we were. The good news is, though, we have been below like the whole year this year, and we're actually starting to come up compared to everyone else based on previous years as well. So those newer listings are coming on the market. We're now starting to see more listings come on the market compared to previous years. So pretty cool to watch. Total advertised stock levels are now 4.2% higher across the capital cities than they were this time last year. As properties take longer to sell, however, total stock is slower to accumulate in regional Australia, with both new and total listing counts lower than a year ago. So Australia is up 4.6%, combined capitals is down 1.2%, and combined regionals is down 1.2%, and combined capitals is up 8.1%. So yeah, new listings is quite strong compared to total listings altogether. Standout there is Adelaide with 38%, compared to more for new listings. What have we got? Rest of Vic is 22%, rest of South Australia 22%, Sydney and Melbourne is still sort of 14 and 12% respectively. And then total listings for Hobart is up 60%, which is crazy numbers. Weekly clearance rate. So the combined capital cities clearance rate continued to trend lower through July, averaging 53.5% in the 4 weeks to July 31st. This is down from the 74.4% in the equivalent period of 2021. Wow. So averaging 53% in the 4 weeks to July. Very low clearance rates. What this means is essentially properties aren't selling at auction or have a very low rate of selling at auction. And so they're either passing in or sold prior to auction or purchased after auction, but not actually selling on auction day. It just goes to show you the strength of the market. Not a lot of bidders are there wanting to bid, and Sydney, Melbourne's pretty much predominantly an auction market, so it is a little bit different in most of the countries outside of that. But yeah, just sort of showing you that Sydney and Melbourne, when it comes to auctions, aren't as strong as they have been historically. I mean, this is the lowest that it's been since essentially 2020, going into that lockdown period of COVID where you actually couldn't hold an auction. So that's pretty interesting. Rental market, so rental rates. Rent values continued to climb 0.9% in the month of July, marking the 6th consecutive month that growth in rent values has been higher than home values. Australian rents are now 9.8% higher over the year to July. So pretty significant numbers here. They've increased. If we have a look at this chart, we were down sort of 1%. The changes of rent have now gone up to 9.8%. And there's a few things that have impacted this. I think the biggest one predominantly is a lot of people have realized that if you're going to be locked down, they don't want to be locked down with certain friends and family and in a place that's cramped. Maybe a lot of separations have happened during the COVID period or whatever that sort of looks like between friends or family or partners. And essentially everyone sort of want to be in their own space and have their own space. And so, I think overall there's a good chart on this actually. I can't remember what it's called. It's, I don't think it's going to be on the RBA chart pack actually. But the number of people living with friends significantly decreased. People living with their parents significantly decreased. People living with partners significantly decreased, and people living on their own significantly increased. So that increases the demand pretty significantly as well. Again, we've got some really high inflation numbers, and markets have gone pretty crazy over that time, and so it does all sort of feed into this dramatic increase. But yeah, it's quite large here considering. Through July, Australia gross yields rose 3.41%, up from the recent low of 3.21%. In January this year, since the end of 2021, gross rent yields in Sydney have lifted 34 basis points and 23 basis points in Melbourne. So this is typical rental yields across the country. We've got Sydney at 2.8, Melbourne at 3, Brisbane at 3.6, Adelaide at 3.7, Perth at 4.4, Darwin at 6.1, which is high. And then regionals, so regional New South Wales is 3.7, regional Vic is 3.6, regional Queensland is 4.5, regional South Australia is 5.1, and then nationally it's about 3.4%, combined regionals is 4.1%, combined capitals is 3.2%. So the yield is almost a percentage difference between regionals and capitals. Dwelling approvals and housing credit. So over June, the total number of new dwellings approved was 16,000. This was down just 0.7% from the previous month, but is sitting 4.7% below the decade average due to relative low unit approvals. So unit approvals are down, so are housing approvals essentially. Combination of things here. Supply constraints increasing the price of building materials, supply constraints with tradies and getting access in time with tradies have come down significantly as well. So the cost of construction has gone up, which means people are less likely to build in this type of economy, and I think that's kind of delayed the whole process through those things. I mean, we're definitely not seeing like a significantly negative number. It's not that different, 5% down from the decade average, which isn't huge, but it is a number. And so, yeah, again, it'll be super interesting to watch over the next little while as those supply issues start to straighten up and we can import and export a little bit more freely. Inflation comes down, and it'll be interesting to see if those approvals go back up. Finance and lending. So lending for property purchases fell negative 4.4% over the month of June. Each borrower segment saw a decline in value, with investor lender falling negative 6.3% and owner occupier lending down 3.3%. First home buyer lending declined 10% in the month. Wow. So first home buyers are not actively looking in last month. So owner occ versus investors. Investors definitely seeing a bit of a tick down. Owner occ a bit staggering up and down over the last couple of months, but investors are starting to come down here. And then portion of new lending for investment housing as a percentage. So, it's about sort of 33% of new lending is for investment purchases, and that's excluding refinances. So it's for new purchases or new investment purchases. That's about 3.3%. And it looks like the decade average here is around 3.4%. So we're just below the decade average, but it is coming off a very small low of about 20 to 25% during the COVID period. But looks good that we're back up to the decade average here as well. Investors and lending. So nationally, investor finance comprised 33.8% of new mortgage lending through the month of June, dipping below the decade average of 34.8. That's what I was talking about. Bigger dip in New South, normal in Vic, big dip in Queensland. Interesting to see. There's so many things over there that are impacting it. Is it the new land tax that's come in that's having a bit of an impact? Is it, changes to the economy, changes to the interest rates, all those sorts of things? But there is a big dip from Queensland. And I'm hearing a lot of that on the ground. A lot of people who were inquiring about Queensland have now pulled the plug or stopped the purchase and looking at other states, which is a pretty sad thing for the Queensland. I understand, it did go quite crazy, and there's probably things that they wanted to do to slow the market, and whether that new land tax legislation remains in until it actually comes into play in 2023, whenever that is. It's going to be interesting. It's going to be very interesting. South Australia is down, but WA and Tas look pretty normal to me. First home buyers. So nationally, first home buyer finance as a portion of owner occupier finance declined from 23.5% in May to 21.9% in June. First home buyer finance overall fell 496 million in June. So first home buyers are definitely coming down now. Across the country, about 21% or 22% of all purchases are first home buyers. The rest is either investors or upgraders. Very interesting. And then obviously the big elephant in the room is the RBA lifted rates to 1.85% in August. We are now higher than pre-pandemic levels, and we've done that very quickly. So pre-pandemic, we were sitting at about 1.5 cash rate. Then we very quickly came down to 0.1. Actually, not very quickly. They took some time to get quite low. And then we were sitting there for a good, year, 6 months, I think. And now we're up to 1.85. And how high does it go? We haven't been above 2.5% since 2012. So, for us to get somewhere like that will be very interesting. And how long we'll sit there for will be very interesting as well. It is a number that is starting to get higher and higher than a number that people are used to previously. My personal thought process around this, and obviously no financial advice, but my personal thought process is people saved pretty significantly during the COVID period because they literally couldn't do anything other than work and sleep and eat and not go out and eat. They had to eat at home and cook at home. So they saved a lot of money. Once we came out of lockdowns and everyone got some confidence back in, they started to go out and spend that money. That along with some supply constraints across the globe, has led to inflation, alongside all of the money printing that happened during the COVID pandemic as well. So lots of money handed out during the COVID pandemic. That money's now all sitting in savings account. People came out of the pandemic and said, stuff this, I only live once, I'm not going to waste my life, I'm going to spend everything. They've gone out and spent a lot of money. Inflation's ticked up, and now the RBA are trying to counter this inflation and emptying the coffers of people's savings accounts by increasing the cash rate pretty heavily. Also trying to constrain probably the property market with this as well. Not wanting to hopefully burn the property market, but not let it get out of control. Pull some savings out, and then once the supply constraints across the country and the globe slow or sort of free up, and inflation starts to come down, and people don't have as much savings in their savings account, I personally believe that they'll bring down the cash rate at some point in time, depending on what the unemployment rate is and all the other economic factors that they look at. So I'll just read this out. So statement highlights: the RBA lifted the cash rate a further 50 basis points in August, taking the cumulative hike since May to 175 basis points. Underlying inflation through June at 4.9% remains well above the board's 2 to 3% target. However, inflation is expected to decline later this year before declining back toward the target range. GDP growth is expected to slow in the coming years, with the RBA central forecast for GDP growth is 3.25% in 2022, followed by 1.75% in 2023 and 2024. The board expects to be doing more to normalize monetary policy in the months ahead, but will be guided by the outlook of inflation in the labour market. Now, housing credit. So in June, the average long-term fixed rate was 4.54% for new owner-occupier loans and 4.73% for new investor loans. Average new variable rates were 149 basis points lower than long-term fixed rates for new owner-occupier borrowers through June. So owner-occupier fixed rates greater than 3 years was at about 4.54%. Less or equal to 3 years is at 3.69%. And then variable was 3.05. And then for investors, variable rates at 3.39. Fixed rate for less than or equal to 3 years is about 4%. And then fixed rate for greater than 3 years was about 4.73%. Housing credit. Mortgage origination for riskier types of lending trended lower through the March quarter of 2022. Regulators and policymakers are closing monetary lending standards. The March quarter data shows lenders are becoming more cautious in their approach to higher debt-to-income ratio lending and higher LVR lending. Yeah, so I think despite all of the Shiraz and Wagyu beef stories that have been out there of late, in the RBA making some pretty significantly changes back in 2018, which caused a bit of a downturn. I think lenders are. I actually don't know, but the general feel and consensus is that lenders are being more cautious with lending when it comes to sort of 6 times income, and if we just have a look at this, so loans originated with a debt of income ratio higher than 6 times. We're starting to come down from those periods that we saw during COVID pandemic where people could borrow more than 6 times income. That's on a bit of a decline. We'll probably get back to levels like 15-16% that we were seeing here in previous years. Loans greater than a 90% LVR, again, has come down pretty significantly, peaked back in September at 14%, and now we're at sort of 9.5%. So people who are actually lending, regardless of what the banks are doing and allowing, looks like they're being much more conservative here with the LVR to ratios and how much they're borrowing. So yeah, very interesting to see. Percentage of loans on interest-only terms. Yeah, so only 20% of loans are on interest-only, which is pretty interesting. Cool. So essentially from here, now I want to jump into the Australian economy and just go through a few things. So GDP growth is now back at 4%, which is higher than the average over the last little while. Definitely seen the economy bounce back up pretty significantly from the COVID slowdown and starting to still come down, but it's good to see that's quite strong. Biggest contributor is consumption, so people have lots of spending and they're consuming a lot of things. compared to like, dwelling investment, money investment, non-money investment. Government spending is quite high as well. Export and imports are down though. So it's pretty much government spending and consuming, people enjoying life outside of the pandemic. What else is going to look at? CPI. So inflation, the way they record it these days, is at 6.1%, which is quite high and pretty silly. It's on a massive trajectory. We're actually at negative inflation back in 2019, and it's been massive trajectory since then. Hopefully it levels out at some point in time. When you start to work off a higher and higher base every time, as a percentage basis, it should start to come down. I do feel it will be higher for the next little reported period, and potentially the one after that. But at some point in time, I think it will start to level out, hopefully. Household income and consumption. So disposable income is starting to come down pretty significantly. Consumption has gone up and came down. And then the savings ratio is now coming down to some better averages here. We're sort of sitting between, call it 6 and 8%, even since back in 2010 or 2009, 2008. Then we peaked during the pandemic. We were saving, probably closer to 20%, 24% here. And now we're back down to about 12%, 12 to 14% there. So saving a little bit less, which is great. The other thing to note is consumer sentiment. It's down to pre-pandemic levels. So everyone is feeling the pain of these interest rates and cash rates moving. Everyone's a little bit unsure about the economy and how everything's running from that side of things. Still saving strong, which is quite good though. So we won't see a bit of a move or a shift in the current sentiment until this moves up a little bit. It's something that I love to watch over a period of time. House prices versus household debt. We can see household debt keeps climbing since back in 1992, great year, to 2%. Be interesting to see if this still keeps climbing as alternative different ways of lending comes into play. Housing prices we've just essentially gone through as it starts to come down. Business investment, NAB private survey. So business conditions are pretty good, looking at a percentage basis. Business confidence is pretty normal considering, and that's a very different story than consumer sentiment. So businesses are still feeling okay in this economy compared to other methods. What else have we got in here, which is decent to have a bit of a look at? Wage price index. So wages definitely coming up, which is great. We haven't really had strong wage increases since back in 2012. So, if we can start to get higher wage increases, that'll start to, you don't want to spiral inflation where you earn more than you spend more than inflation increases, so you have to earn more. But to see some stronger wages coming through, I think is really important. But the labour utilisation rates are really interesting as well. So the underemployment rate is down to 6%, which just means, the people are working, but they want more work. And then the unemployment rate itself is something like 3.4%, which is, the lowest we've ever seen since, recorded history on this chart. And so essentially, the RBA are happily continually increasing interest rates because people still have jobs. And this is the data that they're watching to make those decisions. And so when people start to have less unemployment and less underemployment, that's when they might decide, okay, we've probably gone too hard, or we might need to slow down, or what that looks out for there. There's lots of things that they look at, but this is definitely one of the main ones. So good to see that. We've got a strong economy. Everyone's employed. Everyone's happy. We've got savings. We've got money to spend with our savings, and so the hit to the pocket of the interest rates hasn't been as bad as it would be if we had really high unemployment and really low savings. And then I'm pretty sure that's about it. I know they've got like the lending in here as well. Cash rate we've seen come up. Yeah, Australia lending and policy. Bond rates and bond spreads. And then housing interest rates we went through in the CoreLogic report. So all looks pretty good from that side. So yeah, hopefully it's always good fun to go sort of check out data and sort of see what's happening out there in the economy across Australia. Lots of interesting stuff happening, different time in the market, interesting time in the market. not necessarily bottom of the market, or clear that it is the bottom of the market, but we are definitely starting to see some declines. And this data is all lagged, and so it can change overnight. I think one of the biggest things to watch with that change is consumer sentiment. Whenever that changes, people get a little bit more confident, and it starts to compound, and see what the RBA does from that side of things. But interesting time in the economy. Looks pretty comfortable or okay from my side of things. Lots of elements at play across the country and across the economy, but the biggest hit to the pocket is the cash rate coming up. But hopefully you enjoyed this, guys. Let me know if you want me to keep doing more, and I'll speak to you soon.